All right, everyone, are we ready to re-explore the wonderful world of 417? I would say some of you would be kind of like, okay, it's been a while. Like Sydney, it's been like, what, 2 years almost, hasn't it?
Yeah, it's been forever.
Yeah. Ellen, you're probably still traumatized from last semester, so it just really kind of depends on the situation. Before we get started, I did want a couple announcements. So first of all, apparently, even though I'm an accountant and I have count in my name, my job title, I can't count. There's actually 13 people in the course and not 12. So it did make for a little bit of an interesting breakdown. I didn't want to do one group of five. I think a group of five was just way too big. So we're doing one group of four and three groups of three for the projects, which I think will be fine. 3 or 4 is going to be reasonable. Yeah, that was my bad. I apologize for handing out misinformation. It was not something I did. It was accidental. That's what I'm trying to say. It was accidental. Yes, conveying some information. Yeah, and I was gonna think what I was gonna do is I was gonna blame Kirsten for not being here. She's the one that I didn't want to blame Kirsten though, because I noticed that on my YouTube video for Monday that there's a thumbs up, there's a like on the YouTube video for this particular session. And I think that's Kirsten watching the video wherever she's at in Europe. So thank you, Kirsten, appreciate that. I've often wondered how the algorithm works, and just like randomly some of my videos get like thousands of views, and I'm not sure how to do it. I think maybe if I mention like really, really big pop culture things, it links them. Like it's like Sabrina Carpenter, you'll love this video on auditing. You know, it's just like really, really weird. So I'm just saying like, yeah, people who like Sabrina Carpenter and Chapel Road, you really love this video on engagement planning and risk assessment. You know, and see how many YouTube hits we get for this particular video. All right, I'm going off the deep end. I'm sorry, guys. On something that's more relevant, does anybody remember back from 417 when we talked about Dixon County, Illinois? It was a case that we did in controls, and that was the lady who owned the ranch and was defrauding the city. Her name was Rita Crundwell, and I mentioned at the time that there was a documentary on it called All the Queen Sources. Apparently, ABC decided that one documentary was not enough, and they're actually releasing a documentary. It's going to air tonight. It's called Scam Goddess, which apparently also the name of a comedy podcast, but Scam Goddess. Dr. Hayden actually sent this out to me and let me know this. And so I'm kind of interested to see how this is going to compare to the documentary that Kelly Richmond put together. But if you were really, really ever interested in that case and you're just kind of like, I'd really like to learn more about this fraud, then that's something to know. And we may talk about this a little bit more in forensics in this class as well. But that's kind of something, some interesting news. It's very rare that something that we talk about in auditing comes to the forefront. It's like, that's why we always talk about Enron, because everybody's heard of Enron. So I'll try to open up a little bit more. All right. That was the fun part, guys. You get ready. Here's the in-depth stuff. So let's go ahead and preface all of these discussions.
Could you try
again? That's okay. That's okay. That's okay. That's what happens when like a prompt is like, say, like, let's see, hey Siri, and all of it comes on, yeah, but I don't know, something like that. All right, I'm getting distracted again. You guys don't want me distracted. I go way off base. I was really struggling in the AIS class last week. I was just going way too deep. But I'm trying to stay on task. All right, so before we get started on the review, I do want to clarify. One of the things that characterized one of the characteristics that we had for 417 is we did a very heavy emphasis on publicly traded companies. And I'm not saying that's going to change substantially. We are going to talk about publicly traded companies in this course, but it's important to note that auditing is not just publicly traded companies, that we do need to know the rules for private companies as well, so non-issuer companies. So just as a reorientation about what we've talked about, remember the oversight bodies for public companies. What was that group called? PCAOB, the Public Company Accounting Oversight Board, okay? And then the standard setting body for private companies, does anybody remember that one? ASB, the Auditing Standards Board, and they're a subset of the AICPA, all right? The good news is we're not going to relearn a whole lot of rules, at least for the most part. I do have bad news. When we get to Wednesday and we have to start talking about the audit reports for ASB, remember the PCAOB audit report says, it's just too much information, Dr. Barnes. Well, I'm about to throw a whole bunch more information at you. The reason I do that is not to be cruel, but it's important to remember that the CPA exam is administered by the AICPA. So they're going to be very focused on their rules. They do ask incidental questions about PCAOB rules as well, because they do realize that CPAs operate in both realms. but you do need to know the rules that are covered both sets of stamp setting bodies. The good news is that so far, the amount of information you need to know about IFRS, or I shouldn't say the IASB rules, are very, very minimal. But we do need to know both sets of rules, so we're going to have to talk about the nature of both of those. And for most part, I'd say 95% of the rules we're going to talk about, they're the same. We don't have changes between the two. It's important to know the distinctions, though, as we go through this. All right, so auditing, just a quick remember, an organization, who are the principals in an organization? Shareholders. The owners, yeah, the shareholders of the company. Who are the agents? Managers. And keep in mind that there is that these are absentee owners in an organization. They do not do the day-to-day operations, so they don't know everything that's going on. So there's a difference in what the agents know and what the principals know. We call that concept information asymmetry. Now, it would go to say that information asymmetry in a perfect world would not be a big deal because the agents would basically do everything that the principals told them to do, and there would never be any distinction. But because information asymmetry exists and because we are human beings with free will, agents can frequently act in the interest of, or in their own interest rather than the interest of the owners and the principals. So that is called that's kind of the concept of conflict of interest. And think about that. Conflict of interest takes many dimensions, but it's very easy to characterize. All right. What is ultimately my goal? My goal is to teach you all auditing. What is your goal? Your goal is to basically get through the class and get a good grade with minimal amount of work possible. I mean, to be fair, Truman students will go above and beyond, and they'll work a little bit harder. But if I said you're going to have to work 30 hours a week on my class, would anybody think that's a reasonable approach to it? You can go ahead and free shake your head. I'm not going to be offended. That was an extreme example for a reason. All right. So yeah, the idea being is that just because we have similar interests does not mean they're necessarily aligned. One problem that we see in corporate environments is that stakeholders of an organization, the shareholders organizations, want that organization to exist in perpetuity. Whoever owns Amazon, whoever owns Walmart, they want their shares to exist in long periods of time because they gain wealth over long periods of time. That's not necessarily what the executives want. The executives want their bonus. And so they can take actions that go against the interest of the stakeholders, the shareholders, and to increase their short-term wealth. Now, that's not the only reason that agents act the way they do. Sometimes they're going to be acting the way they do to avoid the scrutiny. They want to keep their job. Sometimes they're going to act because they think that's what the shareholders want. They say, our earnings have to be a certain amount for us to be happy, so they're going to act in the way to make those earnings come into place, even if it's fraudulently. Regardless of what it is, we do know agents can kind of act in their own manner. That's a conflict of interest. Our job as auditors is we're going to eliminate that conflict of interest. We're going to mediate that conflict of interest, okay? And so we actually sit in the middle of kind of this information asymmetry loop. We basically say, you have to prepare financial statements. You have to develop controls. We are going to look at that information. We're going to look at the controls. We're going to look at the financial statement information, and we're going to determine, does it make sense? Okay, is it reasonable? So that is ultimately our objective, is to try to make sure that this information asymmetry that exists, that we can testify to that. So the agents don't have to do all the work themselves. Or sorry, the managers and principals don't have to do all the work themselves. This is really, really odd. I've been struggling between principal and agent. I never do that. It's a Wednesday. I guess that's why I usually I'm not having to struggle with that. I've got to do the same lecture in auditing a little bit later today, so it's really weird, but at least part of it. Yeah, so principal and agent. So we do the work of the principals. They don't have to do all the work themselves, but they can rely on the auditors to actually give them reasonable assurance. Reasonable assurance the financial statements are free from material misstatement. Reasonable assurance that the controls are designed and operating correctly. That's ultimately what our goal is. All right, so auditing is a business, okay? We're going to be, as auditors, we're going to go out and we're going to find clients to do the work on. And just basically, if anybody comes up to us and says, we'd like you to audit our company, we're just going to say, hey, great, more money for us, right? Not quite, okay? Keep in mind that auditing is a highly litigious industry, okay? It's a highly litigious industry, which basically means that if we don't do our job properly, or if something bad happens, we can be found at fault. We're actually going to look at some examples of that. It's actually a lot less litigious than it was back in the 1990s. Basically, if you coughed the wrong way back in the 1990s, then you could be sued under the existing legislation at the time. So it's not as legislatively problematic as it used to be, but it's still enough that if auditors don't do their job properly, they can be held accountable. So we do need to make sure that we follow the proper steps in client acceptance, and when we do have clients that we've been working on, that we follow proper steps in client continuance. We're not going to go through all the different steps that we talked about in 417, but I do want to talk about at a high level what this means. So first of all, if we're talking about client acceptance, we do need to investigate a potential client. All right, so we need to actually look into find information. Some of this is fairly intuitive. We'll look at the financial health of the organization. We'll look at the management, make sure we have an understanding of the client, their operations. One of the big steps is inquire of the predecessor auditor. And if possible, we would like to get as much information from the predecessor auditor as they're willing to share. Some situations, the predecessor auditor will say, hey, here's our working papers, here's previous years. Go ahead and use that, and then we can kind of roll those forward and use that as our basis for working in the current year. Some situations, the predecessor auditors say, no, we're afraid of litigation concerns. You can't use our previous years, and we're not going to be able to disclose any information to you. It really is up to the predecessor auditors to what they'd like to know. But ultimately, what we would like to know as a client or as the new auditor is we'd like to know, why is it that the client has requested a change in auditor? That is a big reason. Now, it sounds like it's nefarious. It sounds like that they're going to say, well, the client's evil, and they're going to twist their mustaches like they do in the old-timey cartoons. But that's not really necessarily the case. When we talk about changes in clients or changes in auditors, it could be something as simple as the client has outgrown their current auditor. Does anybody would know what Amazon used to be? Amazon.com used to be a textbook seller. Okay, that was actually, I remember back in 2003 buying textbooks through Amazon.com. I said, this is a pretty good place. I hope this never grows to be a multinational company that'll take over the world. Yeah, I didn't actually say that, but yeah. But they've grown and they've expanded their operations and expanded their business model. And so what probably fit for them as being audited by a smaller entity is no longer appropriate because they're now one of the largest companies in the world. So as companies grow over time, their needs grow as well. So that's one big reason we might see a change there. So that's going to be kind of what our concerns are when we talk about accepting a new client. Now we're moving on to, we're talking about other issues that we might want to do, investigate between a client. We might want to make sure we understand the client's ability with respect to financial reporting and internal controls, creating internal controls, and their integrity in that regard. We have concerns about their ability and integrity. This might not be an engagement that we want to join on. We would also want to know the auditor staff needs. Staffing is a really important concern. If we do not have sufficient staff, it's probably not a good engagement for us to go on to. And then auditor independence is a really big one. We're going to talk about that a lot this semester. Remember all those rules for independence we talked about back in 417? Yeah, those still maintain importance and prominence. Most of them are fairly intuitive, but it's really, really critical to assess those in every single engagement. Okay. As far as moving on to what if we're going to try to determine if we want to retain an existing client. So we've actually got an existing client. We've already audited them, and every year we make that assessment. Do we want to continue auditing them? Now, assuming they want us to continue auditing, that's obviously an issue as well. If they want to fire us, then we don't have any say in the matter. But if they say, we'd like you to audit again next year, we have to answer a few questions. Do we want to continue auditing? And what are the things that we consider? Well, generally, there's going to be two characteristics. The first one is there a contentious relationship with management? Are there frequent accounting disputes? If you're an auditor trying to do their job and you say, all right, I would like to be able to audit this part of the business on this date. And they say, you know what, we prefer not to do that. In fact, you can't audit that at all. Like, okay, well, we're going to have to make an adjustment in order to be able to do that. Says, no, we're not comfortable with that adjustment. If it's really, really difficult to work with a client, that may be a reason for us to say, you know what, we're done here. Okay, you can find another account to work with. The other possibility might be if there's concerns about the audit fee. And this comes up more frequently than you might think, simply because the client has one belief about what they should pay for an audit. We as auditors generally have another belief, and our belief is generally going to be higher than what the client wants to pay. So there has to be some compromise in there. And if there's no compromise, there can be no deal. Assuming all that takes place, and we're going to say, all right, we are going to have a new engagement, or we're going to continue on the existing engagement, that's when we need to issue an engagement letter, all right? And when I talk about an engagement letter, it's that old cheesy joke that I made 417. I copied it over for this guy, because I know you guys expect me to make cheesy jokes in this class, and I'm not going to let you down. I'm not going to let you down, all right? That's my vow to you. Anyway, issue engagement letter, it's not this type of engagement. What is an engagement letter? The engagement letter is the contract between the auditor and the client, all right? Now, there are a lot of aspects to the engagement letter, but I'm going to let you in on one thing that you will need to know for the CPA exam. The AICPA is very concerned about 3 required sections of the engagement letter that are required for every single audit engagement that has ever taken place. First of these is going to be the objectives and the scope of the audit. All right. What is the audit trying to accomplish and what is the auditor going to do as part of that? Okay, so the objectives and scope of the audit. Secondly is going to be auditor responsibility. What is the auditor going to be responsible for as a course of the audit? What is that with respect to financial statements and with internal controls? And it's pretty intuitive and sensible because you all have taken one course before. That's going to be testing those items, making sure that they operate reasonably for controls and that the financial statements are free from material misstatement. And then also management responsibility. We want to make sure we know what management's responsible for. Now let's go ahead and get this out of the way because this is something that we've repeated multiple times. Management's responsible for the presentation and preparation and fair presentation of financial statements. Okay, so management creates those financial statements. Management is responsible for design, implementation, and maintenance of internal controls and ensuring their proper operation. Okay. Also, something that we need to note with specific respect to the audit, management is going to coordinate all information and personnel that are going to be responsible for reporting on the audit. So any information that the auditor requests, management is going to be responsible for making sure that they get that information. Any personnel the auditor is going to observe or make inquiries of, management is responsible for getting access to that. So that's a lesser one because it doesn't deal with more of management's overall objectives, but that's something I want to throw on there because that's going to be disclosed in the engagement letter as well. All right. As far as the auditor's work, the auditor is going to determine how much work they have to do. And I'll be honest, with all the work that I did back in audit, it was only a 5-year period, but sometimes that was a lot of work with a lot of long hours. It really made me feel good whenever I could walk into an engagement and the internal audit function says, we're here to help you out, okay? And that was actually fairly new when I started auditing. Like the few years right immediately before I started auditing, there was actually no help from the internal audit function. There was the PCAOB had actually set their standards and they said, you cannot use the work of internal audit function to gain assurance in audit. That was like for a period of 3 years that happened. And I'll tell you right now, clients hated it. The auditors, accountants loved it, especially the partners, because they were like, okay, that means extra fees, that's extra money. We're eating that lobster tonight, okay? So yeah, it was a good time to actually be a partner, but not necessarily a good time to be an auditor or a client. That changed shortly after I started auditing and basically said, we can actually rely on the work of the internal audit function. So what does that mean? Well, the internal audit function, they're the people who work for the client and they do a multitude of tasks, but that includes maintenance and controls on behalf of management and making sure that the financial statement preparation processes are consistent and accurate. So if we walk in as auditors and say, we'd like to utilize the work of the internal audit function to gain some assurance with respect to our work, we hope that that's the case. And that's going to be true, but we do need to note that we have to consider a few things. We have to evaluate a few things as the external auditor. I kind of probably should clarify. Keep in mind that we are talking about our position as the external auditor. We're an outside party that's going into a new client with very little information about the day-to-day operations. We're learning as we go along. The internal audit function, that's somebody who's hired specifically by the client. They do the work. They work for the client, and they are reporting to management directly. So in order to be able to use the internal audit function's work as the external auditor, we must evaluate the following: the objectivity of the internal audit function, the competence of the internal audit function, and their application of a systematic and disciplined approach. Now, I do think it's important to remember all of these. Something you may note if you start doing your CPA prep, you may say, I see objectivity and competence a lot, but systematic and disciplined approach doesn't pop up. This is actually PCAOB specific. I'm not going to test you on that. I think it's a waste of time to try to memorize that. But if you just see objectivity and competence, those are the only ones that are actually required by the ASB to be assessed. Okay, those first two. But all three have to be assessed under PCAOB guidelines. All right. So moving forward, oftentimes when we talk about who auditors are ultimately responsible to, they're going to be talking about a party that's generally referred to as those charged with governance. And when we talk about governance, who do we generally think of with respect to corporations? Who's the governance function of a corporation? The board of directors, okay? Now, if we're talking about small companies, even if we're talking about private companies that do have a board of directors that have got private issuance of the stock, that may be who the auditors report to, okay? That may be who the auditors report to. And if that's the case, that's fine. Okay, that's consistent for a lot of audits. One of the bodies that we talked about for really large companies that's actually required under PCAOB guidelines is a subset of the board of directors. Does anybody remember what that was called? The audit committee, okay, audit committee. So what is the audit committee? It's a subcommittee of the board of directors that's responsible for financial reporting and disclosure process. Okay. Now, a few things to note about the audit committee. So the first thing to note is this is the party that must approve the engagement letter. That engagement letter that was that we talked about before, they've got to be able to look at that contract and say, this is reasonable, we approve part of that. So they're actually a part of that process. Also, Sarbanes-Oxley Act Section 407 says there are some rules related to audit committee composition. So let's see if anybody remembers those rules. There were a couple of rules that we specifically talked about in 417. Does anybody remember one of them?
It has to be, I think one of them has to be a CPA.
Close. And one of them has to be a financial expert, but not necessarily a CPA. It probably would be a CPA, but somebody who's actually been a part of the reporting process in a capacity such as a controller or a CFO, which is usually going to be a CPA, so that's pretty close. But it has to be a financial expert. Does anybody remember the other rule? So they have to be outside independent board members. Okay. What does outside independent mean in this capacity? They can't be managers of the organization. So you can't have a manager be on the audit committee, which makes sense because we're testing the work of managers. It would probably be silly for them to have oversight over that. So outside independent board members, at least one financial expert. So what are we going to be doing when we talk about audit strategy and we approach the audit? So in establishing the strategy, we're going to do a few things. We're going to determine the scope of the engagement. Now, it's important to note when we talk about the scope of the engagement, for an audit, for financial statement audit, this is usually going to be comprehensive. We're going to look at all aspects of the financial statements reports. We're also going to be looking at internal controls to at least some degree. Okay. We're going to talk a lot more about different engagements later on that are still going to qualify as audits, but they could be scaled back in scope. They could only look at part of the financial statements, or they could exclude internal controls, or we could talk about engagements that are going to be less in scope, provide less levels of assurance. But for the most part, scope is going to be comprehensive for what we're going to be talking about, at least initially. We also want to plan the timing of the audit, which we're going to talk about, I think, a little bit more in the next lecture. Maybe it's this lecture, I don't remember exactly which. But does an auditor perform everything, all their tasks a year initially? No, usually we actually have some split of timing where we perform interim testing and we perform year-end testing. Now, the big difference is that interim testing is more convenient, allows us to do more work. Year-end testing is going to be more comprehensive, give us more assurance. And remember the analogy I gave you guys back in 417. I said that if I do an interim test and interim exam, that's going to be easier for you all because you have less to study, but it's not going to be a true measure of your full extent of knowledge in the course, only your knowledge to that particular point in time. The same holds true when we talk about audit testing in the real world. All right. We also need to determine the focus of the audit team's efforts. What areas need to be focused on? Now, this one's a little bit more distinct between depending on the client that we look at. Remember Earthware Clothiers that we talked about back in 417? What was the nature of that organization? What was their business model? Does anybody remember? They're a retail inventory company, a retail sales company, okay? So what's probably one of their big accounts that they were going to be testing? Actually use the word inventory. We're probably going to be very concerned about inventory. Would that be true if you were the auditor for KPMG? Why? How does KPMG distinct from EWC? KPMG is a service organization, okay? It's a service organization. So they're going to be less focused on inventory and more about the services provided by their personnel. So the skills that are going to be there. So again, it really is going to be defined by what is the nature of the organization and what accounts are going to be important and prominent in that areas. Identify related parties. So related parties, remember, those are going to be people who have an existing interest in the organization. That's the handshake transaction, because we say if you're not a related party, then you're going to operate at arm's length. That's when you finish a contract, you shake hands. Okay. If you are a related party, you finish a contract, you probably get a hug, something like that. That's kind of the way that arm's length is concerned. Now, what are we as auditors concerned about? Well, the first thing we want to think about is whether or not transactions with related parties represent arm's length transactions. It's hard to argue that they are at arm's length because related party transactions are by definition not arm's length transactions. But we would examine a related party transaction to make a determination of whether or not this appears to be representative of other transactions that are similar in nature. Ultimately, though, our most important objective as auditors is to determine with a related party transaction, are the proper appropriate disclosures being made? All related party transactions must be disclosed under GAAP. We as auditors have to reinforce related party transactions. So this is a point in time where identifying related party transactions, and we're going to be looking at those very, very thoroughly over the course of the audits. So identification of related party transactions is really important in this step. And then materiality, everybody remember materiality? Okay, let's talk a little bit more about materiality. So what is materiality? All right. An amount that's large enough to affect decisions made by a reasonable user of the financial statements. So we're trying to find some sort of arbitrary amount that we say, if a transaction or a misstatement or something along this lines is going to be of this volume, it will affect a user of the financial statements. Now, this really is very, very vague. Even though it's a quantitative calculation, it's a qualitative assessment, because the simple truth is everybody has different materiality thresholds. We're not trying to talk about what every single person has agreed upon. We're trying to determine what a reasonable user of the financial statements is. So if I tried to go through this room and say, what is a materiality amount that you'd be comfortable with? Presumably everybody in this room would have a different amount. I think even John and Colin would have different amounts, okay? But yeah, everybody had a different amount. So we'd have to say, all right, how do we determine out of all these different viewpoints, what is the appropriate amount? And that's the auditor's struggle right here, is to determine what is materiality. So keep in mind the materiality actually has two different levels that we're concerned about. The first of these is going to be overall or planning materiality. This is the maximum amount by which the auditor believes the financial statements can be misstated and still not affect the decisions of users. So let me just ask you this, is $1 million material? Yeah, it depends on the size of the company. Yeah, you guys didn't fall for my trap. Like, it depends, Dr. Barton. So we know exactly what it depends upon, okay? So yeah, it depends. If I say Greek corner euros down the street, yeah, that's absolutely a material amount, okay? I doubt they make that much in a year, all right? If it's Walmart, they'd be kind of like $1 million, whatever, okay? So tell me something that's really important. So yeah, we have to establish that at the financial statement level, but we also need to concern ourselves with materiality at the account level. This is called tolerable misstatement, the allowable amount of misstatement assigned to individual accounts or disclosures. Now, I do want to make a note here because this may come up. In fact, I'm almost positive it will come up in our CPA prep. AICPA is really inconsistent with their vernacular that they use. They like to use this term performance materiality, which technically speaking, when I've seen it used, is supposed to be referring to tolerable misstatement. That being said, I've seen it inconsistently applied to planning materiality as well. So when looking at questions about materiality, please make sure that you understand, are we talking about materiality at the aggregate financial statement level? Or are we talking about planning material? Are we talking about materiality at the disclosure level, which would be tolerable misstatements? That will actually solve a lot of your woes. You won't have to worry too much about the vernaculars used. You just need to look at the question and the context for the question, okay? So that's something to keep in mind as you're moving forward. All right. Other questions regarding materiality. How do we determine planning materiality? Does anybody remember our rule of thumb for that?
5%.
5% of pre-tax income, okay? Pre-tax income. So that's our general guideline. Well, it might be some reasons that we use something different. Well, if we use 5% of pre-tax income as our general rule, and then we're auditing a not-for-profit, does it make sense to use income as a basis for not-for-profit? What do not-for-profits generally not have a lot of? Income, yeah. They generally are not income-based, so probably using 5% of income is not great. That case when we use assets or revenues as our basis, but as a percentage of one of those amounts. How do we determine maximum tolerable statement of the account or disclosure level? So this one was one that's really confusing. And remember, my frustrations vented at this point about the book and how the editors didn't know what they were talking about. And I started went on a rant. And then I'm going to do that again when we get to chapter 3 this semester, because it always happens every semester and I can't avoid it. But keep in mind, this is some percentage of whatever we determine planning materiality. So we say planning materiality is $1 million. And then we say our maximum tolerable misstatement for any one account is a percentage of that. So 50%. Okay. Now, this is effectively an arbitrary percentage. Usually it's a range of between 50 and 75% of planning materiality. But once we establish that, that's the maximum amount for every account. Now, the reason I got so frustrated on this is because this is not an amount that is applied to every single account. We're not saying that every single account is going to be set at 50% of planning materiality. We're saying the maximum amount that we can allow for a deviation in one single account is going to be by 50% of planning materiality. For most of our accounts, it's going to be less than that. So say that I've got $1 million of planning materiality. I say 500,000 is my tolerable misstatement. I go and look at something like intangible assets, which has a $2,000 balance. Am I going to apply a $500,000 misstatement threshold to that? Say this $2,000 account could be misstated by as much as $500,000. Does everybody see why that's ridiculous? Okay. We don't assign that just at that. We don't use that number every single account. We use a methodology to go through and strategically assign to every single account. For intangibles, we probably would say, well, we could probably say $1,000 would be the amount to the sound. So 50% of the account, but it's still a really small amount. Okay. But the most we can assign to any one account is $500,000 because that's the threshold that we've established. So keep in mind, that's how we determine that. Now, an aggregate tolerable misstatement, sum of all of our tolerable misstatements added together should be somewhere within the range of 3 to 4 times planning materiality. Now, you're probably saying to yourselves, if you don't remember this, if you do remember this from auditing, you're like, yeah, I remember this, Dr. Barnes, you can not go on. Some of you kind of like 3 to 4 times, that seems weird. Why would it be more than planning materiality? Why would it be more than planning materiality? Well, keep in mind, this is the maximum amount by any one account that we could have misstated, all of those added together. So all of our maximums added together. Do we assume that every single account we have misstated by the maximum amount? Is that a reasonable assumption as an auditor? So if I say that I may inventory can be misstated by as much as $500,000, and my plant for plant equipment can be misstated by as much as $300,000, and I go through this step for every single account, do I assume that every single account will be misstated by exactly that much? Seems kind of ridiculous. Our goal as auditors would be to say most of our accounts are not misstated at all, or if they are, they're minimally misstated. So that's why we can set planning materiality at 3 to 4 times that amount, because we don't expect to have that level of misstatement for every single account. If we do, we've got problems. That would be where if I walked in an audit and I saw that, I'd be like, yep, we're leaving. We're out of here. We're done. Okay. I'd be the partner and say, we got better things to do. Okay. We got better things to do with our time. All right. What factors can affect the determination of tolerable misstatement? So remember, tolerable misstatement can be assigned at the account level. How do we determine what the tolerable misstatement should be at the account level? Well, probably the most obvious justifier is going to be the size of the account. Remember, I said we had tolerable misstatement a maximum of $500,000, but it doesn't make sense to assign $500,000 in tolerable misstatement to an account that's much larger or much smaller than that. So I'm not going to assign that. So the size of the account is one of going to be the concerns. Another concern, the complexity of the account. If it's a highly complex account, then we might want to have more tolerable misstatement assigned to that account than less. Third criteria, the activity that occurs in that account. If it's a highly active account, frequent transactions, it's more likely to be misstated. And then one that's kind of counterintuitive is going to be a risk. So risk is always one of those dynamics in auditing that makes things really, really challenging. Because if we think it's a more risky account for auditing purposes, we may make the tolerable misstatement less, because we want to be more certain that our assessment is correct. So size, activity, complexity, those generally make tolerable misstatement go up. Risk has an inverse relationship. It makes it go down. Okay. Finally, what is meant by strategic assessment of tolerable misstatements? Everybody remember this, because we had to go through that big old worksheet and you had to strategically assign accounts with certain amounts. And this is one where I said, everybody's going to feel like they don't know what they're doing. And I say that's true for every single person who's ever taken this class. And I think that you're probably more comfortable with that now, but probably still like, I still was just guessing, Dr. Barnes. But what was our strategic approach there? We were trying to determine what is the maximum amount we can assign to an individual account and still stay within that 3 to 4 times aggregate range. The example that I gave back in 417 was planning a Thanksgiving dinner. Okay. So I said, we're going to plan a big family dinner, and every single person who's coming to this meal is going to have a different amount of food they can eat. Okay. I can eat a lot of food. I really, really enjoy a good meal. Okay. My sister-in-law, who's half my size, can eat twice as much as I can. All right. My mother basically eats 3 bites and said, I'm so full. My nieces, apparently they have some hookup to the center of the earth that they don't need food. Okay. They have infinite energy just given by the grace of God. I don't know how that works. Okay. But every single person in that household is going to have a different amount of food they can consume. So when making and planning for a family dinner is going to be a challenge, because if they just say, all right, we've got 10 people here at the meal, let's just multiply whatever Michael eats, that's me, whatever Michael eats and multiply that times 10, we're going to have way too much food. We say, let's just multiply it times whatever Michael's mom, her name is Sally, whichever she eats, we're going to have enough, like a plate for one, enough for that, because she only eats like 3 bites before she gets full. That's kind of the problem that we run into. We need to consider every single account individually and make our assessment for each individual account. All right, audit risk model. Everybody remember the audit risk model? All right, so audit risk is the expressing the clean audit opinion with financial statements and material statement. What is a clean audit opinion called under PCAOB guidelines? Does anybody remember? Unqualified. What is it called under ASB guidelines? Unmodified. Good. Okay. So this is basically what we're trying to do here is we're trying to determine if we're concerned audit risk, we're concerned about saying something is okay when in fact there's a problem. In scientific vernacular, that's a type 2 error. We don't really concern ourselves as auditors with type 1 error. That's saying there's a problem when in fact everything's fine. We're more concerned about the latter, the type 2 errors. Okay. So audit risk model can be specified as the following: AR equals RM times DR. So we already know this is audit risk. What does RMM stand for?
Risk and material mistakes.
Yeah, risk material misstatement, and DR, detection risk, okay? We can further break this down into AR equals IR, CR, DR. What is IR? Inherent risk, CR, control risk, yeah, and then we have the detection risk, okay? Now, a few things to note about here, all right? Detection risk is what's going to be established by the auditor. This is what we actually determine what work we need to do in order to get an adequate or to get adequate assurance to issue our opinion. So this is something the auditor has control over, and we'll talk about what control the auditor exerts over detection risk in just a second. The aspects of risk and material misstatement, inherent risk and control risk, these are functions of the entity and its environment, okay? We have no control over those as auditors. We assess the levels of those, but we do not actually affect those. We can't change inherent risk. We can't change control risk. All we can do is determine what they are, what we believe they are being. All right, let's go ahead and talk a little about each individually, because it's really important to understand these to be able to know what concerns about. All right, so first of all, inherent risk. What is inherent risk? Inherent risk is the risk and material misstatement for any consideration of controls. So you go into business, and by virtue of being in that line of business and being in the area that you're in, you have certain risks that you're subject to. What are some examples of these risks? High volume of transactions, complex calculations, estimates, the industry or the environment that you operate in, which might actually depict risks of recession or obsolescence. Even a lack of working capital. So I'll just repeat those in case you're going to take a note. So high volume of transactions, complex calculations, estimates, operating environment, lack of working capital. Those are just a few examples. There's a lot of different types of inherent risk, but those are some ones that I made note of. So by virtue of being in that business, you're subject to certain risk. For our companies that we usually talked about in 417, inherent risk usually defaulted at high because we were talking about publicly traded companies that are in complex operating environments. But when we talk about control risk, we know controls are response to those inherent risk. What is control risk itself then? Control risk is the risk that any controls will fail to prevent or detect and correct a misstatement. So a client is going to create controls to respond to the risks they identified up here. There's a high volume of transactions. Well, let's make sure we have a secure, strong operating system with knowledgeable people who can understand the nature of these transactions and make adaptations as necessary. We've got good controls surrounding this particular inherent risk. All right, that's the goal. But in fact, it could be that the client has not implemented adequate controls in a particular area and that we still have risk existing after the controls are in place. What are some concerns specifically with respect to controls? Basically, there's two tiers of concerns. The first of all, that the controls do not exist in a specific or for a specific area of risk or for a specific assertion. The controls are not existent. We say that's a deficiency in design. Okay, deficiency in design of controls. They've not been created. What if the controls are present? Okay, they're designed properly, but they're being ignored. Is that a possibility as well? Yeah, we go through the habit of making segregation of duties in certain areas. So you're responsible for custody, you're responsible for recording, you're responsible for authorization. And you leave the room and said, you know what? I don't want to split these up. You know what? I'm just going to give you my responsibility. I'm just going to do my work on my own. Okay. That's bypassing controls, and we call that a deficiency in operation. So we're concerned about design and operating effectiveness with respect to controls when we test that as auditors. Okay. We are concerned about both of those aspects. Now, again, auditor has little or no control of these risks, but what we are going to do is we're going to look at these. We're going to look at inherent risk. We're going to look at control risk and make assessments of what we believe those both are. In most situations, we're actually going to test controls. Now, we'll talk about the scenarios in which we don't test controls. Does anybody remember what the strategy is when we don't test controls, what that was called? Called a substantive strategy, okay? For the most part, we're going to use what's called a reliance strategy. That's relying on the client's controls to gain some of our assurance, okay? We talk about that, we test controls, we come up with control risk, and we determine with assessment of what audit risk and what risk material misstatement is. That's going to help us determine detection risk. Detection risk is the risk that audit procedures will not detect a material misstatement. This is where things get a little bit wonky, okay? So audit risk, we establish, usually this is going to be low or very low. It's pretty much a constant. Risk of material misstatement is predicated on what we determine inherent risk and control risk is. This can run from high to low to anywhere in between. Then we have detection risk. We reorder this equation, we say detection risk is a function of these.
Now we know there's a direct relationship between detection risk and an audit risk, but what did I say about audit risk? Audit risk is effectively a constant. So if it's a constant, then that's not going to change. So we don't need to worry about too much of the relationship between the inherent risk and control risk. Sorry, audit risk and detection risk. Why I just butchered that. I got both of them wrong. Detection risk and audit risk. What we're more concerned about is what risk and material misstatement is. If risk and material misstatement is high, what does that mean about detection risk? They're inversely related, so it's going to be low, okay? If risk and material misstatement is low, the detection risk is going to be high, okay? So that inverse relationship predicates what we determine detection risk. Now, this is interesting, because when we talk about risk, we generally think high risk is bad, low risk is good. Is that true for detection risk? This will be saying, and no, I know there's a trap, Dr. Barnes. I know this is a trap. I remember the trap. I just don't remember what it is, okay? Or if you do remember what it is, great. But detection risk represents the risk, the level of risk the auditor is willing to tolerate related to audit procedures. So if we can tolerate a high level of risk, is that a good thing or a bad thing for an auditor? That's a good thing. That's a good thing. If we can tolerate a very low level of risk, that's a bad thing. So when we talk about detection risk, high is good, low is bad, which is inconsistent with the way we think about risk in general. But keep in mind, detection risk is a weird thing because it's talking about risk tolerance. All right. So that actually determines what work we're going to be doing. Detection risk is usually inversely related to the strength, detail, and quantity, or the nature, extent, and timing, net, of evidence the auditor needs to collect. If detection risk is high, it means, hey, we can tolerate a lot of risk in our substantive procedures, then our nature, extent, and timing of tests can be low. We have to do less work. If detection risk is low, that means the nature, extent, and timing is high. Now let's think about this. Let's think about this along the spectrum of the entire series of audit testing. If detection risk is high, what must risk and material misstatement have been? Low. Okay, so we have risk and material misstatement over here, and it was low. Okay, that means that either the inherent risk is low or control risk more likely is low. The controls are good and operating effectively. If you walk into a client and they've got great controls, are you going to think, oh my gosh, I've got a lot of work to do? Or are you going to think, this is great, they've got done all the work for me? The latter. You're going to think the latter. You're going to think, okay, they've got good controls, I have to do less work. Is that consistent with this story here? Yeah. Risk and material misstatement is low, detection risk is high. The work that we do in substantive testing is going to be low. Flip the script, okay? If detection risk is low, that must mean risk and material misstatement over here is high, okay? Risk and material misstatement is high. We walk in, inherent risks are really high. They've got no controls whatsoever. It's like, oh my gosh, these controls here suck, all right? I may have to do more work or less work? More work, okay? My detection risk is low. I can only tolerate a certain level of risk, a very small level of risk. So I'm going to have to expand the nature, extent, and timing of the test that I perform later on. All right. One thing I do want to talk about, I kind of skipped it over a few slides ago, but I want to make sure we're clear about it. So when we talk about the nature of misstatements, obviously we're going to be concerned about different types of misstatements. I do want to talk about some misstatements that relates to. Sorry, actually, I think I'm going to wait on the slide for that. I'm going to do one more slide, then I'm going to get on to misstatements. Okay, there we go. What type of audit procedures can auditor usually conduct during risk assessment? Forward of note, 3 of these we conduct in every single series of tests. And I know that this seems like splitting hairs. Should be like, why do we need to memorize the different types of audit procedures? Mostly because CPA exam, that's the reason why. But remember, we can do these 3 types of tests in every single phase of the audit: inspection of records and documents, observation, and inquiry. And then we can also perform analytical procedures during this phase. Now, the only reason I bring this up is because it's applicable to this phase, but we're going to get into audit evidence gathering on Friday. We're going to revisit this and talk about what each of these represent. So hopefully this will look a little bit familiar. The one note I want you to make is these 3 right here can always be used. They're very versatile types of evidence gathering. All right. So types of misstatements. So before I get into the types of misstatements, this is where I want to talk about that categories of misstatements that I looked a little too earlier. So in generally speaking, when we talk about categories of misstatements, as an auditor, we can assess them in one of 3 ways. The first way is we can say it's a factual misstatement. The factual misstatement is a misstatement about which the auditor has no doubt whatsoever. Example of this would be like an inventory misstatement or an inventory method misstatement. So the client is using a non-GAAP method approved or non-GAAP approved method of inventory. I, as an auditor, can recalculate their inventory valuation using a GAAP approved method and calculate the difference between what they have recorded and what the amount should be. And I know exactly what that difference is. That is a factual difference, a difference about which I exactly know what the misstatement is. The next category is going to be called a judgmental misstatement. This is a misstatement based on the judgment of the auditor versus the judgment of management, okay? So when does this come up? This comes up a lot of times when management is trying to make a little bit more precise expectations than what the auditor believes. You guys remember bad debt expense from 303? Bad debt expense is usually going to be assessed as like 1% or 2% of sales. What if I as the auditor believe it should be 2%, but the client says they want to use 1%? Is that going to result in a different amount? Yeah, and probably material amount if sales are large enough, okay? So those are judgmental misstatements. Finally, we have projected misstatements, and these are basically based on estimates made by the auditor. Usually these are going to involve analytical procedures. So I calculate what I believe a accumulated depreciation should be for a period. I look at the client's amount and I say, this does not match what I believe it should be. I don't understand the difference. Whatever the difference is, that my projection is the misstatement that I've calculated. The amount of what the client's reported versus what I believe the amount should be based on my projection. Now, let's talk about the two types of misstatements, okay? These are less about categories and two different, just very general categories or general types of misstatements. First of these is pretty obvious. When we talk about misstatements, this is an unintentional misstatement, okay? Unintentional misstatements are errors. We can't avoid those because we're human beings. Even our finest computers can't avoid misstatements for us because we're the ones who created the computers, okay? We're the ones who often are responsible for the input. So take that, AI. Right. So if we have unintentional misstatements, we must have intentional misstatements. What are those called? Fraud. Fraud, okay? So two primary categories of fraud. Actually, you're going to be referring to this next week. In our course, we're going to be talking about two categories of occupational fraud, okay? Financial statement fraud and misappropriation of assets, which I just transposed those. So misappropriation of assets is just theft of an asset. Financial statement of fraud is misrepresentation of information within the financial statements. Now, the reason I bring this up is we're going to talk about occupational fraud on Tuesday next week in forensics, and you're going to hear me talk about corruption. Is corruption relevant to business? Absolutely. Okay, it's very, very relevant. It's a very big concern. Is it necessarily relevant to financial reporting? The answer is not so much. It could be in some scenarios, but for the most part, we're going to ignore it in this course. We're going to focus on these two right here. All right, so the two types of fraud. With respect to fraud, when we're responsible as auditors, auditors have a responsibility to design procedures that can detect direct and material effects of illegal acts. So if fraud is taking place, we do have to be able to detect if it's a direct effect and if it's a material effect on the financial statements. So how are we going to do that? Well, through the correct application of our audit procedures, making sure we follow brainstorming processes, but mostly we want to consider the fraud risk factors that are in place at an entity. Now, we talked about this a little bit ago. We talked about fraud risk factors. What is the better way to depict the fraud risk factors? There's three of them. What did we call that when we talked about it on yesterday, actually? The fraud triangle. Yes. Oh, sorry. There we go. Better known as the fraud triangle. Pressure, opportunity, and rationalization. All right. So pressure represents an incentive for somebody to commit a fraud. If we're talking about misappropriation of assets, maybe they've got a gambling addiction and they need extra cash so they can pay off or they can pay for their habits. Okay. We're talking about something like financial statement misrepresentation. You're a CEO of an organization, you want to keep your job, but you're not going to meet your earnings and expectation. So if you just create a few fictitious sales, then that will actually boost earnings to the point that it needs to be. Opportunity is basically the opportunity, the ability to commit fraud within an organization. Oftentimes it's going to be characterized by the controls or the representations you have within the organization. And then we also have rationalization, the attitude that you commit fraud. So basically saying, I'm only going to do this one time. I promise I'll never do it again. I'll repay it once I've got my money back. Or this organization doesn't pay me enough money. I want to make sure that I get what I deserve. Or I need to make sure I keep my job because I really, really value this job. Whatever it is, it's basically how we approach it, how we justify our actions with respect to fraud. With respect to this fraud triangle, we as auditors need to be aware of all three fraud risk factors and be able to evaluate those. But for the most part, we can only affect one of these factors directly. Which one do you think that is? Opportunity. So when we talk about opportunity, those are going to be protocols and systems in place in the organization. If we as auditors note there are poor controls in this area, or these people seem to be colluding in a certain area and try bypassing controls and doing things that they shouldn't be doing, we can observe that and note that as part of our audit. We can affect the occurrence of fraud in an organization. And just like in the fire triangle, remember the fire triangle, Smokey the Bear, only you can prevent forest fires. Fire triangle is basically heat, fuel, and oxygen. We can't get rid of fuel because there's always going to be trees on the planet, hopefully, okay? Can't get rid of oxygen because there's hopefully always going to be oxygen on the planet. We can eliminate heat sources. As auditors, we can eliminate the heat source that occurs with fraud. We're going to eliminate that opportunity, or at least minimize that opportunity, try to minimize fraud. All right, we're done for today. We'll be back on Friday for assertions and evidence.